Joining us now is Bankrate Financial Analyst Mark Hamrick. Mark, good morning. Good to have you with us here. So what is your reaction to the latest developments this morning? The EU matching Trump's 90-day pause. How do you predict this is going to reflect when the markets open this morning?
Well, we see that the stock futures, Chris and Mary, are down this morning. This is a little give back from obviously what we enjoyed in the rally yesterday. And let's remember the major indices, the S&P 500, the Dow, the NASDAQ, are still down year to date. So we really did sort of avoid going into the classic definition of a bear market where the S&P 500 was down 20% on the close, but we did touch that during a trading earlier in the week. And so where we are this morning, and we have to acknowledge that it feels like things can change in a minute, is that we're still dealing with the apparent certainty that there will be baseline tariffs of 10% globally, and that we're in a trade war with China, and China is obviously responding in kind. So we're still dealing with some negative developments. Uncertainty continues, and we've all been through something in the last week that included some steep declines in the stock market, which translates to the erasure of wealth in people's accounts.
And Mark, as it comes to China, to put this into perspective, China is one of the country's top trading partners. U.S. government reports that last year, imports from China went up 2.8%. So how big of an impact is this going to have on consumers and the market?
I think a big one, and this is why economists, I think, will continue to say today, as they sort of go to their spreadsheets, the risks of recession have risen. They aren't as large today as they were 24 hours ago. The risk to further inflammation of inflation continues high. I think we have to brace for an increase in prices because tariffs are taxes on imports coming into the United States, and downside risk to growth exist. And so we're still in a boatload of uncertainty here.
Mark, we hear from the administration that 70 countries have picked up the phone looking to negotiate some type of deal moving forward, although there's no deals at this hour. But with a country like China, where it's really almost different than all the other countries that the administration is tariffing, how much more of a process is that working with a country like China?
Well, I think when we look across the globe, we acknowledge that, China is among our largest adversaries. And so history is replete with plenty of examples where a trade dispute or trade war did erupt into something more significant. So we're still dealing with a high degree of global geopolitical risk. And right now, you have to say relations with China have only gotten worse. And it doesn't look as if, at least on the surface or rhetorically, that the Trump administration is engaged or is interested in being engaged in trying to resolve this with China. So remember that China is going to take its own steps to hurt U.S. producers, including farmers. That's what happened in the earlier Trump administration. And that also has negative repercussions for U.S. output, for U.S. producers of things that have been going to China.
And Mark, we saw the markets bounce back with the 90-day pause. Now the EU implementing its own pause. But in 89 days, are we going to be going through the same thing again? I mean, how often can the market handle this?
The administration is, in a sense, publicly defiant in saying, essentially, we meant to do that. But the reporting of this indicates that it was essentially the burgeoning crisis, particularly in the bond market, that may have compelled the administration to do what it did. And so I think that whether it is something that is as dramatic as what we saw this past week, I certainly hope, pray, and think that we won't be repeating that. I think there has been a lesson learned, but I do think we should buckle up the seatbelt for further volatility in financial markets, and so investors should act accordingly.
Mark Hamrick, thank you.